There we go. All right. Good morning, everybody. I'm going to open up the text chat. And first thing I see is nothing in the text chat. So somebody acknowledge that you can hear me. Boom, there we go. Helen, Tripp, how you guys doing? Stephanie? Excellent. All right. Well, guys, I've pulled off some interesting things in the past, but I am not going to try to pull off anything here in terms of not being completely honest with you. I don't know what to chalk it up to. It might be coming home from the traveling and doing the 2-day inner circle, but I have no recollection of having this be my turn. So I hesitate to say unprepared. I didn't prepare the slides for this program, but the bottom line is, I've spent the last 20 years being prepared to talk about the market and things related to the market. However, in full disclosure, I spaced this one, and I'm looking back on my emails. I don't even see usually, and I get notifications, and I'm not saying they didn't send them. I'm sure that they did, but I guess coming back to the chaos of being gone for 2.5 months, I totally missed it. So it's all on me. It's my bad. However, doesn't mean that we can't have a good time for a while. I do have one meeting, a meeting conflict. I do have to meet somebody in Seattle. And so I've got about 20 minutes. And right now, I will just give you my mea culpa. It's my bad. And I'm going to open this up for Q&A. I mean, this is a trading coaches session. So let's do that. I can and will address anything that you want to bring up. If it's market related, if it's not market related, I reserve the right to say, I don't want to talk about marriage counseling today or whatever it is, but if it's market related, have at it. And so again, please accept my apology. If you want to beat up on me, go ahead, it's your prerogative. But it certainly was not intentional or being dilatory, because I just completely spaced it. There you go. I'll quit talking about it. What do you want to talk about? If there's got to be some things that, I mean, you come here hoping to get something every time, every week. And so what is it? What's on your mind? What has been giving you any kind of challenges, any difficulties? Let's see. Charles says, can we look at CMG? We certainly can. You're going to have to give me a minute to get this pulled up though, Charles. I will get that pulled up on another screen. What else? That'll just take me a second to pull charts up. Go ahead and type things in, guys. Anything. What questions could we possibly address that would be helpful to you to talk about? You know my range or my skill set, so to speak. Most of you do. It's pretty broad. You can throw just about anything at me. Let's see. Yeah, it's still bringing it up. It takes a minute to bring that software up. What's my view on the market for the coming year? That's a great question, Helen. Obviously, I'm going to be inclined to do what I should do, which is the disclaimer for this whole class. And that is to, guys, I'm typing in passwords here. That is to disclaim that I am not prognosticating, giving you any specific advice, nor do I have a crystal ball. But I can tell you my opinion on it, and it'll be stated as such, as my opinion. I'm going to base it off of real estate because I follow that very closely as much as I do the markets, because that's my business. a major part of my business anyway. And the thing is this, interest rates will be coming down by the end of the year. I believe that. The fact that it is stabilizing, the fact that things are appearing to stabilize is an interesting thing. It's the markets hate indecision more than anything else. Markets hate indecision. You have no doubt seen situations where news, which seems to be bad news, can calm markets. Okay, you're waiting, you're anticipating this bad news. The bad news comes out, and instead of markets crashing, they kind of do a sigh of relief. And that's because the anticipation already built the negative into it. And as long as it isn't worse than what we were anticipating, it's a relief. And so you have these kind of relief rallies or these stabilizations on negative news. Right now, the Fed is juggling with a man-made problem, which is the inflation. And their playbook from history is to fight inflation with interest rates. Guys, when money supply is overextended, which is what has happened, we've had an overextension of money supply over the last several years. The Fed and others have put money into the markets, a lot of money into the markets, and it has fueled a tremendous growth. In spite of the pandemic, there was still strength in the market. The pandemic did not cause a recession. It didn't. But inflation is a product of a Fed policy trying to control, is the response to a Fed policy. And when the Fed money supply is extended too far or extended far enough that somebody decides we need to pull the money back in. Now follow this with me. Let's say that you flooded the market with a bunch of extra liquidity, which is what happened. At some point, somebody says, we got to get that money back. The only way to retrieve that money, to pull it back into the control of the banking source. And when I say source, it's a combination of things. You know, our Federal Reserve is not truly federal. It's not part of the United States. It's a separate entity that we contract with. But the bottom line is a banking interest. And when the bank decides to call a note due, or when the market decides to call a note due, there's a scramble time. It's like, oh my gosh, we got to pay it back. And when the Fed decides to pull the money back in, guys, the way they do it is through interest rates and taxes. Okay, that's the only way you can pull that money back in, through interest rate and taxes. Now, you could have tremendous growth in the economy, which would bring in more taxes, which brings the money back. Okay, but the stimulus process, and I'm not being political, I'm being very analytical, and everything that I've seen in decades in the market, the stimulus efforts over the last 2 years, 2.5, almost 3 years, have been the worst possible economic response to the pandemic, in my opinion. And I've seen a lot, and that's my opinion. It's been a horrible response. Dumping and printing money has been more of a political maneuver to gain favor than it has been to solve problems. Why do I say that? Because people have got to be freaking stupid to not be able to look backwards and see that when this has been done in the past, it didn't work. It didn't produce the results. It's like sugar. You can get a kid's attention by giving them some sugar. If they're lethargic, you want to wake them up, you give them sugar. But if you give them too much sugar, you get a meltdown, and you have to pay the piper with a 6-year-old that is hysterical and can't control themselves because they're coming down off a sugar high. And it is not it's not rocket science to look back over history and see how this works. And yet it's a popular thing. I give my kid a snow cone or cotton candy or a big candy bar, I get a temporary quiet. They shut up for a while. They calm down for a while. But you're building a nightmare when it comes due, and it comes due. You have to pay the piper. When you feed too much sugar to a 6-year-old, you're going to pay if you're the parent. Okay, that's just the way it is. And so the policy has jammed so much money out there that now it has to be recovered. And the way you recover it is with inflation and taxes. And it's just, it's a sad thing, but we're facing it and we're going to have to eat this because it's being essentially shoved down our throats. Okay. Guys, I'm going to ask you to hold for just a second. I'm going to try to put, this call on hold by a little bit more time here. Hang on just a half a second to get to this screen. Okay, bear with me for just a second. I'll be right back. Okay, sorry about that, but I did buy a little bit more time. All right, so here we go. What I'm saying is that we are in for a bit of a rocky period because the inflation is being put on us. The interest rates are being jacked up. It's contributing to inflation, and it's just a byproduct of the Fed policy of jacking up the interest rates. And so when I said their methodology is to pull the money back in through taxes and inflation, and I didn't misspeak, but I should explain it a little bit more. The inflation is a result of the interest rates. So they're going to jack up the interest rates. It causes inflation. They're going to jack up taxes where they can. You know, the politician will jack up taxes, and that's how the Fed gets the money back. Guys, you know that the United States borrows every dime that we get every year and more. We borrow everything that we get from the Fed, and we borrow more. We put more on our credit card just to operate each year. All right. So when interest rates go up, when inflation goes up, more money gets brought in, but we still borrow more than we spend. It's absolute insanity, but that's what we have to do. Now, I'm telling you this for the reason. Here's the reason. In spite of that, with the idea that when the news comes out, if it's not worse than we thought, it's a relief and it will cause actual growth. And so what happens and what we're seeing is that people are getting the hint that interest rates are probably not going higher. I mean, they spiked up big time from where it was, more than double. But it's still lower than the long-term historical average. It's still slightly lower than the long-term historical average. And with the warning or with the prognosticating that the Fed will not push it much higher, in fact, by the end of the year, it could be back around 5%, suddenly we're seeing an uptick in the real estate markets that are still strong. Okay, markets that are fairly strong that have been pulled back are starting to rebound again. What does that tell you? It means people's longer term perspectives are, well, okay. Now, is this hurting people in the lower to mid tax brackets trying to buy houses with the interest rates? Absolutely. But the upper end is coming back. They're dipping back into the water, and that will trickle down. People just have to get used to higher rates and being able to buy. They're going to have to be able to spend more money and get less product. As soon as they accept that, the market comes back. The real estate market comes back. If it does, then the market stabilizes. Now, the big catch is if we have some major economic event, and it could throw a wrinkle into the whole thing because we're very vulnerable. But absent some big major economic setback, we could see stabilization here simply at a higher basis. Now, nobody likes it, but the market likes the known. And if it's bad news, but at least it's the news and there's no more big surprises, you get back to business. Everybody does. I mean, guys, think about it. You all do. We all do. You hate it. You complain. You throw rocks, but then you go back to work, right? You go back to living. And so instead of buying a 3,000 square foot house, you're only going to get a 2,200 square foot house, but you're still going to get a house if you need it, because your mortgage payments are just not going to let you get that bigger house. Well, after you adjust to that and you take a deep breath, you go back to life. Okay. So kind of long-winded, but Helen, is that an okay answer? Anybody got anything out of that? I apologize if you didn't get anything out of it, but that's what I'm seeing, that I see a stabilization at a different level that nobody's going to like, but people go back to work, markets go back to work. All right, so let's shift over and let's look at CMG. Hopefully that helped. I'm waiting for Helen to say something. She says, thank you. Yes, that's what I wanted. Okay, good, because that's all I got. Glad you got something out of it. All right, so sharing. Let's go to the screen right here. All right, tell me if you can see the chart. It looks like it, so just confirm. Charles says it was a good answer. Thanks. I appreciate it. Okay, good. All right, Charles, I think it was your question. Let me go back and just confirm. CMG. Yep, that was Charles. What do you want to see, bud? What can we do on this? And then Richard, we will talk about gold. I'll just start going, Charles, if you want me to just analyze this, but if you have a specific question, please say something. Karen says, I'd love to go over the SPY. Okay, we'll do that. SPI. If you draw trend lines and analyze it, absolutely. Absolutely. Okay, so what are we looking at here? We're looking at CMG. This is a weekly chart. Let me break this down to a daily. And if we look at 1 year on this thing, it's not enough. It is actually, it's plenty. So let me explain. When you're looking at analyzing something, if you're looking at a short-term play over the next few weeks or even the next month or so, this is plenty. You don't have to look back to a year or 2 years ago or 3 years ago. It's good. I mean, it is wonderful to give it more time frame. I'll give it here 3 years and see what that looks like. Okay, great. But that doesn't help us if we're looking for a short-term trade. Do you understand? So Charles, I'm going to assume that we're looking at this for a fairly short-term trade, because that's what we tend to trade. Most of the people in this class tend to trade in that time frame. So let's look at a 1 year, because that's all we need. Why is it all we need? Because we have support and resistance levels that are not likely to be reached, right? They're not likely to be reached for months, 2 or 3 months. We are not likely to get up here to the high or dip down to the double bottom, which is a gap fill, and there's all kinds of traffic supporting support down here at 1370-ish, and up here at 1740-ish, there's all kinds of resistance. And we're not likely to see either one of those points in the next 2 or 3 months. It's possible, but certainly it's going to take a month or two to get to any one of those levels. So why do I need to look at 3 years? You see what I'm saying? So Charles, that's the first thing, is this is as big a time frame as you need for the type of trading or the time frame you're trading in. Now we can make the observations, which we will right now, that we've got a support level down here in the 1350 range, 1350, 1360. Why? We got a double bottom. If we look back here, we had a nice fill or gap fill, real nice gap fill on a point that it hit once, twice, 3 times. Okay, so in rapid succession, back in May and June and July, we had 3 major events that happened here around 1370. We had a huge consolidation that failed. We had a rally attempt that failed. We had another rally attempt that failed. 3 major events back here around 1370. Then we have a gap that runs up, and you see where our previous highs were. We ran up there, hesitated, bounced, slipped a little bit, came back and lost it, and then boom, down we go. And we fill the gap once, we fill the gap twice. We have descending tops. So we've got a descending pattern. Bullish moves are tending to fail at lower prices. The bearish support levels where the bulls come back in are consistent. What is this called? It's called a wedge, folks. This is called a wedge. We have support level that has 1, 2, 3, 4, 5 major events associated with 1370-ish. Okay, 5 of them. That's solid. We have 1, 2, 3, 4 failed rallies coming down. And so we have a collision course, a collision course. We have 2 powerful forces that are driving towards each other. When they hit, when they collide, who's going to win? The answer is, I don't know. I don't know. By the time we get down there, we may have 5 failed tops in a descending order against 5 major support levels. And you know what? It throws a great big question mark with a big grin on my face. Here is how you trade neutral, my friends. This is going to be a big collision. This is going to be a major thing. What's good about that? Well, what's good is that we tend to get a big move out of it. We tend to get a big move out of it. Which way? I don't care. Well, you have to care. Are you going to go bullish or bearish? And the answer is, I don't care. If it breaks this support level, answer me this, please type this in. Answer me this. If it breaks this support level, how significant would that be? It immediately sends us looking down here to 1200. Okay, that's 160 points, 150 points. That's a big drop. I like that. Would you be willing to play a 150-point drop? Absolutely. What if it bounces here for a 6th time? You're darn right I'd take a bullish trade, but my anticipation would be not too high because I have a series of lower tops coming down. So I'd take the bullish trade hoping that this is going to be the one that breaks the pattern. By the way, patterns happen how many times, guys? Typically, how many times do patterns happen? Come on, type it in there. You know this. Y'all know this. When you have a pattern, 3 to 5 times. Thank you, Charles. 3 to 5 times. How many times have we failed? Once, twice, 3 times, at least 3. So we have a descending pattern with at least 3 downward rotations. We've got 5 bounces here. We've got a major event happening in front of us. It's coming up, at least the makings of a major event. We're either going to break to the upside and we will likely see a run up here to 1750. That is just what is likely to happen. Or we're going to see a break of the 1360-ish support level and a drop to 1200. Is it going to happen next week? Nope. Nope, probably not. This pattern is developing, and it could take a week or 2, probably 2 or 3 weeks, to get back down to support if it's going to do it again. Keep in mind, however, keep in mind that there is a downward line here that gives us something to watch for. Come on. There we go. Keep this line in mind. If this line is broken, or let me say it this way, could this line be broken before it comes down and hits support again? And the answer is absolutely. Remember, when you have wedge patterns, let's see who can remember this. How far into a wedge do you typically go before it breaks, either to the upside or the downside? Wedges, by the way, what I'm hinting at, almost never go all the way to the point of the wedge. That's where they're projected. That's where they're pointed to collide, but they almost never get there. They almost never get to the collision point. Tripp says 75 to 80%. That's right. I always say around 2/3. I'm looking for a break about 2/3 of the way into the pattern. if you look and project the top line and the bottom line, how far into this wedge are we right now? How would you project? If you look at how much farther it's got to go to collide, how far are we into it right now? Charles says about 3/4. Yeah, close. I would say close, maybe just a little under, but real close. And when do wedge patterns tend to break? About 3/4 of the way. Yep. So could this turn and break to the upside? It could, and that would be a big deal, Charles. If it drops down to support and breaks through, it would still be in about that 75%, 75 to 80% range that Tripp kind of pushed it out. I would say, 70 to 80% in that range. You start looking for it. So this, I think the next move on CMG, either down to support or a push down and then a turn and a rally back up, if it breaks that top line, it's a big deal. If it pushes down and breaks the bottom, it's a big deal. Okay. All right. Charles, was that sufficient? Does that help? That makes sense to everybody? Anybody have any questions on that? All right, fantastic. You guys are awesome. You're giving the right answers, which means you're veterans and or you're quick learners or you're paying attention or all of the above. And I hope it's all of the above. All right, let's look. Now we want to look at, let's see if we can pull this up on this chart right here. Okay. Let's see. I don't have that. Richard has given me a symbol. No, I typed it wrong. Here we go. Let's see. Okay, here we go. All right, Richard, what's your question? He says, how about the gold market for the year? Oh, you want me to prognosticate? All right. First of all, we're looking at a 1-year chart right now. Okay. I definitely want to see more. So I'm going to change the time frame to 3 years on this one, and I'll show you why. Okay. So we see this high back here a couple of years ago, and I'm still not seeing enough information here for what I want to see. So I'm going to change this back and go back 5 years. That's as far as if this futures is going to show me or push back. All right, so here we go. So it's just looking back 1 year still. So I'm going to look first at any significance to where we're at right now. Is it significant? Well, yeah, but how significant and based on what? I would, let's see, do I want to change? No, I'm not going to change that. I would first look at the downward slope that we have broken since November. Okay. First of all, is there a correlation? Is it parallel? And the answer is, yeah, there's a parallel. It may not look that great to you. However, you have to keep in mind when you're going downhill, it's the bottoms that have to line up, not the tops. The tops will line up to some degree. Sometimes they're perfect, sometimes they're not. But when you look at a channel or regression line here, which I've just done by eye, you're going to see that the downward, there's a rally, failed rally, failed rally, failed rally, failed rally, failed rally. Does that correlate with the inside lines and the outside lines? And it does. That's just fine. So now we say, okay, but we broke out of that. Yes, we did. And what are we looking at? Well, we have to take this line here, then we project up here on top a parallel line, and don't see anything getting there yet. I don't see where we're at as a major resistance level right now. I don't see it a major resistance level. So what we look at is a target, and that target is going to be up here. That target coincides, depending on how long it takes to get there. Let's say it takes a little while to get there. It coincides with highs. So over the course of the next few months, if interest rates continue to stay where they're at, which they likely will, they don't see bottoming or pulling back until a little bit later in the year, then we could see a push for gold that would continue to push on up. Now, this is given that there remains indecision and fear in the market. If the markets stabilize, when the fear starts to subside, gold prices will subside with it. Gold is a hedge. It's a hedge. And if you look at this push, this jump here in futures is pushing up out of last fall. And we had the midterm elections. We came out of the midterm elections and the gold prices started to rise. Why? Well, I mean, you can try to read all kinds of things. I've heard all kinds of explanations in that, but the markets respond to what happens, but they respond in how they perceive that, what they perceive the value of what happened, not just on its face value. That's why earnings can come out and the markets can go, yeah, I don't care. Yeah, but they were great earnings. Yeah, we kind of figured that was. So it was already factored in. If they already had anticipations of what was to worry about, what was going to happen based on midterms, it's being reflected here in the gold futures. And it looks like this is still continued on an upward trend. From a targeting standpoint, we're past this last major resistance level. The next one is up in this range where that next blue line is, up around 2051. Will it get there? I don't know. But if it follows the pattern, it will. If it goes to resistance, it will. I'm seeing an interesting thing down below here. When we look at this down here, this is open interest. This is contract trading, open interest contract trading. And you can see that there was an extreme jump in volume in November and December. And that volume is pulling back. The open interest, which is that's just a reflection of the number of open contracts, unclaimed contracts, or not that are actually open out there in the market. It is dropping. So whatever caused this knee-jerk reaction for about 2 months is now backing off a little bit. That is associated with the drive in the market. So the last comment I'll make is you can have a target, you can be heading in that direction. If you look down and you are leaking gasoline out of your tank, or your electric battery is draining out faster than you thought it was or has been, you can say, well, we're still pointing on the right direction and we're still heading there, but I see a problem here. We're losing momentum. And this looks to me like it's losing momentum. So I don't know if the markets stabilize, if they kind of adjust to the interest rates and things start to kind of settle in, then the drive or the momentum to use gold as a hedge will soften. And if we look at open interest depleting, it may be an indication that that's happening right now. Okay, so that's my thoughts on that, Richard. You can tell me what you think on that, but that's the way I see it. Karen wanted to look at the SPY. Charles says, do you teach the inner circle all the time? Oh, no, I do it, I think, twice a year. Richard, you're welcome. All right, Karen. Let's see, Stephanie. Would you wait for it to break 1650 to be bullish? Well, that's on that downward pattern, Stephanie. And you've just got to see how it's going to, if it goes up there, even if it's bullish, it may break across the line and pull back a little bit. It may test the line and pull back. But if you get on the other side of that descending line, your upside target is up there at that 1770, 1750-ish. So, and it doesn't go there in a straight line. It likely takes, 1 or 2 moves, but that's the breakout point that we were talking about. All right, let's take on the SPY here. All right, Karen, you got to tell me what you're looking for. What are we looking for here? Raj says, how do you get open interest in volume? Well, you don't. There's two indicators on that chart down there. That's a futures contract, right? So you're looking at volume, trading volume, and you're looking at open interest contracts that they were both showing, and they correlated. You have higher volume of trading, you have a lot of open interest. When open interest falls, that means people are closing positions. They're either running out of time or they're closing those positions. So it's either way, it's an indication of a shift. Does that make sense? Okay, Karen, I'm still not seeing your, there we go. Let's see. The 1 year line pattern says we bumped it and dropped. Are we going down? Okay, good point. So we are looking back here because we have a, let's see, we kept that on the multiple years, didn't we? 5 year. So we're looking back 5 years on this thing right now. And that's good because we see the big run up that we are correcting. So Karen, I would say, let's do some math. We go back down here to 215 and we go up here to 478. Okay, 215, 478. Our pullback here is to 355. So let's do some math here, guys. What percentage of a pullback, and you can do it with your eyes, you can probably do it with your eyes. What percentage of a pullback off of the last rally have we had? Now, we're not talking about a pullback of the entire market from its zero to its high. That gets into the bear market projections of 10 to 20% for bear markets. But on the in retracing the last major bullish run-up, Karen says about 50%. It's less than 50%, guys. You should be able to see that. It's less than 50%. Now, on a bullish run, what is a healthy pullback? In other words, on a bullish run, a healthy retracement has got a number to it. In other words, when I say healthy, what would indicate a continuation of a bullish run? If you only have a 10% pullback, it's still hyperinflated. It's hyperheated. It's superheated. If it pulls up 60%, we got a problem because you just gave up more than half of what you just gained. What is considered a healthy pullback to keep a strong bullish trend going? I love trips down 23.6 to 38.2. I'd love to know where you got that. It's 30 to 50%, guys. 30 to 50%. Trip says those are fib levels. Exactly. But the market maximum is 30 to 50%. 30% is considered ideal. And where does 30 fall in Tripp's 23.6 to 38.2? Booyah, dead center. Barry, 20% is still a little hyper. That's a little bit too aggressive. It's wonderful if you're in it and following bullish, but it means that you're still burning fuel too fast. Okay, so Barry, think of it this way: if you're doing exercise, you exercise in a burst for so long, and then you rest, and then you burst again, and you rest. If somebody's very fit, they can burst for 60 seconds, and then if they rest for half of that, which would be 30 seconds, and then go again, that's considered a good bursting rate. But if somebody goes for 60 seconds all out, and after 10 seconds they go, I'm good for another one, they probably can, and they'll do another 60. But if they only rest for 10 seconds, that third 60 it's going to cost them. But healthy burst training is push hard for 60 seconds, for example, rest for 30. Push hard for 60, rest for 30. You can continue to do that for quite a while, and it builds strength to where you get stronger, and you can do 60, 30, 60, 30, 60, 30. The more fit you are, maybe you go 60, 20. That's a 30% pullback, 33. Okay, you get it? So if you are really healthy, if you're really strong, you can burst for 60, rest for 20, burst for 60, rest for 20. And you could do that 3 to 5 times before you have to take a serious rest. Whoa, what about that? Wait a minute, 3 to 5 times? Isn't that the way the markets tend to burn off bullish runs or bearish runs? You push hard, and oftentimes you'll see that first one is a big push, then a little pullback, then a big push, but not quite as much, then a pullback, then another big push, but not quite as much. And then it's, oh gosh, I got to take a break. Why? Because you're going too fast. You're not resting long enough in between. And so a 30 to 50% retracement will continue a bullish run longer. It's a stronger run. Everybody get that? It's a stronger run if you can rest for 30 to 50% of the burst. And right now we're looking at about a 40% pullback. I would say I would give that about a 40% pullback. All right, it's still in that healthy range. We've got a double bottom. Let's lay the tops down and we go, wow, you could straighten a string on the tops of those pullbacks. And I see a wedge forming. Does this look a little bit like CMG? I see 1, 2, 3. We're in our 4th rotation on the downtrend. We have solid support down here that correlates back here with activity. Now that activity gives us a little bit more range on the downside for testing purposes. But with 4, we're starting into our 4th rotation. Could it go 4 or maybe 5 on the way down before it finds support? Yeah. And guess what? This support level right here is exactly 50%. That next major support level. So 30 to 50% is what you should be looking for on a healthy retracement. And Tripp says, hey, it looks like CMGI tends to follow the SPY and the SPX. Hello. So could you go and do an overlay CMG on top of a SPX chart and see how it correlates? And if you did, and if they correlated, you could say, wow, the S&P follows CMG. You could say that, but you'd be wrong. What you get out of that is we have a follower. CMG tends to follow the SPX or the S&P 500 or the SPY. It tends to follow them very closely. Okay, good. A lot of stocks do. If the S&P 500 is a reflection of the top 500 companies, then it's going to reflect the behavior of a lot of those companies, because the more alike they are, the more it will show up in the S&P. So right now, what you're looking at is a nice retracement, 4 rotations down. We're starting into the 4th. We have a targeted support level. It's at 30 to 50%. And are we, by the way, let's use the 50% retracement line here. That's the middle of our support. How far are we into the wedge? Using this line. Using this line, how far are we into the wedge? The wedge starts, by the way, right here. All right, there's your starting point. How far into that wedge are we? At least 2/3. 2/3 to 3/4. If patterns tend to break 2/3 to 3/4 of the way in on a wedge, what happens if the S&P turns and breaks to the upside? Would that be similar in projections to the S&P 500? Yes, it would. And if it did it coming off of the last rally, you would have this. You would have the angle of attack on the next bullish run. However, if it breaks that blue line that I just drew, it likely goes back down, and I wouldn't be surprised if it goes down to 340. Goes down right into the middle of that support level and tries to find support. Tries to find a home. And then if it broke, wow, here we come 220. Look out. But it could rally off that point. It wouldn't take too much to break the downward pattern, and then you'd have some support and you move to the upside. But right now, we're about 3/4 of the way into this, and we've got we're into our 4th rotation. There's nothing that says that this isn't in a good position for a bullish breakout. If it does, we'll likely see gold go down as a hedge, and we would see, you know, a market saying, okay, we don't like the interest rates and we don't like yada yada, but we're back in business. Okay. All right, guys, that's about all the time I got. I apologize, but that is all the time I got. And it turns out that that took the entire hour. So, but I will be on my way because I don't want to be late to another commitment that I've got. Thank you for your time. I hope that you enjoyed this. I love it. This actually is my favorite. My favorite scenario is stump the dummy, you know, just get up here and just start throwing stuff at me. I love it. I absolutely love it. So I hope you got something out of it. Thank you for the nice comments. I again apologize for not being prepared, but then again, I am prepared. It's just a matter of for what. All right, thanks, Helen. I appreciate that. Karen, thank you very much. You're very kind. Raj, thanks, buddy. Carl, Charles, Tripp, everybody. All right, take care. God bless. Have yourself a wonderful day. Bye now.